Hey, what's up guys? John here. Mortgage rates are skyrocketing, far above what we're led to believe. If you actually go out there and apply for a home loan today, you'll be shocked at just how expensive it is for a 30-year fixed rate mortgage. And what I believe we are going to witness is going to be a once-in-a-lifetime opportunity to invest in single-family real estate, 2 to 4 unit residential multifamily deals. There's going to be so much opportunity coming for the smart and savvy entrepreneur with great credit, with strong cash reserves, stable income, taxes done, buttoned up. Those people are going to be able to go out there and pounce on so much opportunity. On this channel, I talk about personal finance, real estate, business, and money. And I'm the founder of CashNow.Video, which I believe is going to be America's #1 credit repair company by 2024, with helping over 1 million people fix their credit. Because what's ultimately happening, the middle class is getting completely evaporated. And we're going to witness what's going to happen now with these mortgage rates. We're going to likely see prices fall in a very, very, very big way. And during that is going to be the opportunity for the people that have, been preparing for this. I've been talking on this channel for probably a year, a little bit more, that this in the past, 2021, was the time to sell real estate. It was the time to really accumulate cash and to make money in the greed because there was so much of it. And in 2022, it was warning everyone that we're going to likely see more uncertainty. 2023 and 2024, we are going to see so much uncertainty that it's going to really help if you have great credit and cash reserves. Take a look at this. This is pretty crazy. Please hit the like button. Hit the like button. YouTube's going to share this content to educate more people about what's going on. So if you have bad credit, 640 credit score, 30-year fixed rate mortgage, 8.5%. This is on October 21st. 30-year mortgage, 8.5%. Now that mortgage, 2021, you could have gotten that for 2.5%, right? That is absolutely crazy. If you have the average credit score in America, which is 698, you're looking at 8.264% for a 30-year fixed. If you have perfect credit, 850, 800 credit score, 7.512%, right? So you're looking at what's happening. Rates are going to really continue to rise, I believe, especially if Jerome Powell, they're continuing to increase rates. We're going to likely see this reflective in the mortgage market. Not the time to be greedy. Home flippers are now getting burned by the U.S. housing downturn, slashing prices to cut losses. Here are 2 big reasons why. Now, last year was the time everyone was talking about house flipping and all the money that could be made in Airbnb and all these speculative real estate asset classes that were being formed, as they normally are during bubbles. Everyone's diving in. Now, at the end of the day, what we are likely going to see is these home flippers reducing their prices or walking away from their properties. And we're likely going to see the same thing occur with a lot of Airbnbs that no longer pencil out on long-term leases. Now, here's what they're saying. Home flippers who pounced on recent drops in home prices now face some major hurdles and potentially major losses. It's a story few could have foreseen. Except for me, I was talking about this on this channel, after home flipping, and the reason I was always saying that you got to be careful if you're flipping a house, if you are a home flipper and you're buying homes at the height of the market and you get caught, like what's happening right now, who's going to be the buyer that's going to be coming in to buy that brand new turnkey property? And that's the big question, because what buyers look for when markets are changing is they want to get into the neighborhood. That's all they care about. They want to get into the neighborhood. They want a decent house that they can fix up over time. They're no longer getting the bells and whistles, the granite countertops. They're no longer getting all of the perks that one would expect during a great bull market. Instead, they're on a defensive position. So what do? They buy the house flip last. That's what ultimately happens. And then these home flippers get hurt even more. Reached record heights in 2022. As 2022 picked up, the bubble seemed to have burst. The 1 in 10 home flipping conventional sales ratio has dropped as the overall real estate market hits the brakes. Home sales fell off a cliff between August and September and dipped an astounding 25% from October 21st, according to the National Association of Realtors. It's now causing many property investors to dump their inventory fast. And anybody that's flipping right now needs to be looking closely at pricing a property. Well, how do you price it? You give a 10, 15, 20% margin of safety. What happens if it takes you 6 months, 9 months to turn over this property and interest rates continue to rise at the rate in which they're rising? 10%, 15%, that won't be enough, right? So you really have to buy a deal at 50%, 60% below market to be able to hedge in some real safety. because we just don't know, right? It's pure speculation. And if you're going to bet your entire life savings or a large block of your equity in a deal, not knowing what the future is going to look like, knowing that there could be a lot of home flippers more desperate to get out front of the property than you are, maybe with deeper pockets, that could be a bad situation. Prices to sell. Today is not time to be greedy. President of Capital Fund, a hard money lender that does business in Phoenix, Colorado, and Texas, told Bloomberg that TikTok made $17,000, right? So, I mean, what we're going to be seeing here, slumping demand, this is only going to continue. But I always find it very fascinating to see what the economists, the experts say is going to happen with the housing market, because what they say is very different than I believe what actually happens. What they're saying is this is the top economist according to Market Insider. This person, for example, Jeremy Siegel, he said, I expect home prices to fall 10 to 15%. Home prices have risen 30% in a lot of markets in the last 24 months. So you're expecting that this market correction is going to be half of the appreciation in which was assumed over the last 24 months. Meanwhile, a $500,000 home price with $100,000 down, 30-year fixed rate, 2.5% mortgage was about $2,000 a month, right? That same mortgage today, even at 7%, which you're not getting a 7.14, maybe you are. I mean, if you're a really great borrower, you're getting a $315,000 home. Same economics, same monthly payment. You can afford the $2,000 payment. You're at a $315,000 purchase price today compared to a $500,000 purchase price, right? So you're far above the 10 to 15% just on affordability. So the big question becomes, what happens to all of these people that purchase these homes for $500,000 and they lose their job or they're impacted by the economy and they need to refinance their homes? They're not going to be able to refi. They don't have equity in the property, and so ultimately they're either going to have to lease the property or they're going to have to sell the property. We're going to see a lot more people that are going to be forced to offload inventory, right? So to say that we are only going to see a 10 to 15% correction seems very unlikely. And I mean, we'll see, but this is what he's saying. But again, this is in my opinion, good news for someone that wants to be a real estate investor. There's plenty of doom and gloom channels out there that talk about, I talk about money. You want to make money, this is what we talk about here. I think there's going to be some big opportunities to make money in real estate coming very soon, catching all the greed that was just in the housing market. But when they say 10 to 15%, I disagree entirely. Buckle in, assuming rates remain near the current 6.5%. 6.5% is what they're saying rates will assume at. This came out 8 hours ago. So they're saying rates are 6.5%. No, that's not going to likely happen. I mean, even perfect credit, 800 above is 7.5%. So, yeah, I don't know. Maybe he made this statement and then they released it 2 or 3 weeks later because rates were much lower. But rates now, you're in the sevens, right? And so he's saying that the national home price will fall almost 10% peak to trough. Most of the declines will happen sooner rather than later, and home prices will fall 20% if there is a typical recession. How could there be a typical recession when we have everyday households that are paying a tax of about $11,500 in just inflation cost? So they're paying this massive inflationary tax. We have 52% of all employers scheduling layoffs. We have over $1 trillion in outstanding credit card debt, $1.6 trillion in auto loan debt, most of which is vehicles that are underwater, meaning that they owe more on the vehicle than they're probably presently worth. And we are going to be stepping into a situation where people are going to, have higher utility bills. You have 20 million Americans with higher utility bills, or with utility bills in which they cannot pay for. So to say a typical recession almost leads us to believe that we're going to enter a, almost like a 6 to 8 to 12 month type of inflation or recessionary environment. I think it's going to be much, much worse than that. I'm anticipating a once-in-a-lifetime opportunity to invest. That's going to probably be great in the Great Recession. In a recent housing report, he said, the housing market is most interest rate sensitive of the economy. It's on the front lines of the fallout from the Fed's efforts to bring down inflation. There's going to be a coast-to-coast downturn in the housing market. It's going to be brutal. No part of this market is immune. And then David Rosenberg, a veteran economist, he says, we have massive housing bubble right now. Most of the housing balance sheet is in residential real estate, and it's in equities. Rosenberg said in a Real Vision interview released this week, the Economist pointed to the Fed's tightening efforts to bring inflation down from its recent 8 to 9% to its target 2%. So 8 to 9% is what they're saying inflation is. And they want to bring it down to 2%. And they said that the one in which way that they'd be able to do that is to bring unemployment from about 3.6% to about 4.2%. So I think they're way off base here. And I think that for them to actually bring inflation down to 2%, it would not be smooth. Let's just put it that way. They want the stock market to go down. They want home prices to go down. Why? Because there's not a snowball's chance in hell that they're going to get down to 2% holy grail consumer inflation without there being a period now of asset deflation. It's 100% necessary. And that's why I believe people should be sitting on cash. And the last thing people should be doing is sitting on high interest consumer debt. And if you have high interest consumer debt, there are ways out of it, but you need to just do the research, build out a plan and strategy. If you have late payments, derogatories in your credit report, we'd love to help you. Free consultation at CashNow.Video. Call us at 561-430-5900. I mean, there's just absolutely no way that the everyday American is going to be able to take full advantage of this situation, paying 20% interest or 30% interest, because people need to sit on cash. And it's hard to sit on cash if you're paying somebody else 20%. The average economist agrees that there's a severe downturn coming, but he expects it will be a while before higher interest rates really hit home prices and demand. The Fed's rate hikes have indeed led to a sharp fall in applications for building permits. However, construction employment hasn't yet begun its decline, presumably because many workers are still busy finishing houses started when rates were lower. And wider economic effects of the housing slump still may be many months away. I mean, what do you think about this situation? Do you believe that we're going to start to see a real housing recession? We look at rates go from 2.5% to 7%, 7.5%, 8%. I mean, the average American's credit score, to put it into context, 699. They're 8.264%. Right? This is massive. This is huge. This is happening very, very quickly. But I'm curious as to what your thoughts are on this. I think we're stepping into a once-in-a-lifetime opportunity to make a ton of money. I mean, to where you could multiply your net worth 10 or 20x if you play this right. What do you think? Drop below. Let's have a conversation about it. Hit the like button. Subscribe here. Subscribe on my second channel. And LinkedIn, Twitter, Instagram, and TikTok up in the banner. If you need help fixing your credit, we'd love to help you at CashNow.Video or call us at 561-430-5900. If you're a business owner, you're dealing with clients that have bad credit, we'd love to partner with you. Feel free to call us as well. We can talk about how we can work together. All right, talk to you later.